Something is happening to gold right now that should not be happening. Gold is falling during a global conflict. Let me repeat that. While geopolitical tensions are rising, while oil prices are unstable, while central banks are buying gold at one of the fastest paces in modern history, gold is going down. If you've been following the traditional playbook, the one that says, buy gold when the world gets unstable, then what you're seeing right now makes absolutely no sense. And that confusion is exactly where most investors make their biggest mistake. Because when something breaks the pattern, people assume the pattern is gone.
Because when something breaks the pattern, people assume the pattern is gone. They think gold is no longer a safe haven. Maybe this time is different. Maybe I should exit before it gets worse. But here's the truth. Almost nobody is explaining clearly. Nothing is broken. The pattern is still intact. You're just looking at the wrong phase. And if you don't understand what phase we're in right now, you are going to make the exact decision that destroys your position right before the move begins. I have spent decades studying how gold behaves during crisis periods, from the oil shocks of the 1970s to the aftermath of September 11th attacks to the recent Russia-Ukraine war. And what's happening today is not new. It has happened before, repeatedly, predictably. But the explanation you're hearing in financial media, it's incomplete, because this is not about headlines. This is about a mechanical chain reaction that almost no one breaks down properly. And once you see it, you won't just understand why gold is falling. You'll understand what comes next. And more importantly, you'll understand why this moment may be one of the most important positioning opportunities of the next decade. Let's get something clear right away. Gold is not falling randomly. It's not broken. And it's definitely not failing as a safe haven. What you're seeing right now is a mechanical reaction, a chain of events that starts far away from gold itself and ends up pushing its price down even when fear is rising. And unless you understand this chain, nothing else in this market will make sense. It begins with oil. When geopolitical tensions rise, especially in regions that control energy supply, oil prices react first. That's exactly what we've seen during conflicts linked to the Middle East, particularly around the Strait of Hormuz, where nearly 20% of the world's oil supply passes through. Even a small disruption there sends shockwaves through global markets. Oil moves up fast, sometimes violently. Now here's where most people misunderstand what happens next. Higher oil prices don't just mean expensive fuel. They trigger inflation expectations. Not actual inflation immediately, but what markets believe inflation will become. And in financial markets, expectations move faster than reality. When traders see oil spike, they immediately start pricing in higher inflation, and that changes everything. Because once inflation expectations rise, central banks, especially the Federal Reserve, are no longer free to do what they were planning. Before the shock, the market may have expected interest rate cuts. But rising inflation risk forces the Fed to pause or even stay restrictive longer. And that leads to the next step. bond yields rise. The U.S. 10-year Treasury yield, one of the most important numbers in global finance, moves higher as markets adjust to the idea that rates will stay elevated. Now think about what that means. You can suddenly earn a higher return from a risk-free government bond. No storage, no volatility, no uncertainty, just yield. And gold? Gold pays nothing. No yield, no income, no cash flow. So institutional capital starts doing simple math, and some of that capital rotates out of gold and into bonds. At the same time, something else is happening quietly in the background. As global uncertainty rises, investors rush into U.S. assets for safety, especially Treasury bonds. To buy those assets, they need U.S. dollars, so the dollar strengthens. And here's the critical part. Gold is priced in dollars, which means when the dollar becomes stronger, it takes fewer dollars to buy the same ounce of gold. So gold price falls. Now step back and look at what just happened. One event, a geopolitical shock, triggered three simultaneous forces: higher bond yields, a stronger dollar, capital rotation away from gold, all pushing gold down at the exact moment people expect it to rise. That's why this feels so confusing. But it's not random, it's mechanical. And once you understand that, the real question is no longer, why is gold falling? The real question becomes, what happens when this entire mechanism reverses? Now that you understand the mechanism, we need to talk about something even more important. What happens after this phase? Because if you only look at what gold is doing today, you'll misread the entire situation. But if you zoom out, you'll start to see a pattern that has repeated again and again and again for over 50 years. Let's go back to 1973. During the 1973 oil crisis, oil prices didn't just rise, they exploded. Supply shocks hit the global economy. Inflation surged and uncertainty spread everywhere. And gold? It didn't immediately skyrocket. In fact, in the early phase of that crisis, gold showed volatility and hesitation very similar to what we're seeing today. But then something changed. Over the following years, gold didn't just rise. It surged over 2,000% from the early 1970s to its 1980 peak. Not because of not because of panic, but because of what came after the initial shock. Now move forward to the Iranian Revolution, another major disruption in oil supply, another spike in energy prices, another wave of global uncertainty, and again gold didn't behave the way people expected at first. There was hesitation, there was volatility. But within the next 12 months, gold rose roughly 80 to 90%. Then came the Gulf War. Oil surged, markets reacted, fear increased. Gold had a short-term move. But the bigger gains came later, once the initial shock settled and the deeper economic effects began to unfold. After the September 11th attacks, markets were shaken globally. Gold didn't instantly explode, but what followed was one of the longest bull runs in history, from around $250 to nearly $1,900 over the next decade. And more recently, during the Russia-Ukraine war, gold initially spiked. then pulled back, then moved to new all-time highs. Do you see the pattern? It's subtle but incredibly consistent. Gold does not always reward investors at the moment of maximum fear. In fact, during the early phase of crisis, it often does the opposite of what people expect. But once the underlying forces begin to shift inflation, policy, currency dynamics, gold starts moving with strength. And that move is usually much larger than anyone anticipates. This is why most investors miss it, because they focus on the wrong moment. They react to the drop instead of preparing for what comes after. And history is very clear on this. The biggest gains in gold don't happen during the shock. They happen after the system starts adjusting to it. So the real question is no longer, why is gold falling? The real question is, where are we in this cycle right now? Because once you answer that, everything changes. To understand what's happening right now, you need to stop thinking in headlines and start thinking in phases. Because gold doesn't move randomly during crises. It follows a pattern, a repeatable, structured sequence that has played out across decades, from the 1970s oil shocks to post 9/11 to the 2020s. And once you see this pattern clearly, you'll realize most investors are reacting at exactly the wrong time. There are 4 phases, and everything happening right now fits inside one of them. The first phase is panic. This is where the event hits. Oil spikes. News explodes. Markets react emotionally. Gold often jumps quickly at first, a sharp spike driven by fear. But that spike doesn't last, because almost immediately the mechanism we discussed kicks in. Yields rise, the dollar strengthens, liquidity tightens, and gold begins to fall. This is the phase where confusion begins. Retail investors chase the initial spike and then get trapped as price reverses. Institutions, they're not chasing anything, they're watching. The second phase is absorption. This is where things get dangerous. The headlines calm down slightly. Volatility decreases, but gold continues to drift lower or sideways. This is where doubt sets in. Investors look at their positions and think, maybe I was wrong. Maybe gold isn't working this time. Maybe I should just exit. And this is where the majority of people sell. Not at the top, not during the spike, but here, at the point of maximum uncertainty. What they don't realize is that this phase has historically been the transition zone, not the end. The third phase is the structural bid. This is where the real move begins. The forced selling dries up, the panic fades, and long-term buyers step in. Central banks continue accumulating. Institutional capital reallocates. Smart money begins building positions quietly. Gold stabilizes and then starts to climb. Not violently at first, but steadily. And this is the phase most people miss because they already exited in phase 2. The fourth phase is new all-time highs. This is where everything becomes obvious. The narrative flips. Media turns bullish. Retail investors rush back in. But by this point, a large part of the move has already happened. Now here's the critical question. Which phase are we in right now? Because if you misidentify this, you misplay everything. So where are we right now? Not based on opinion, not based on headlines, but based on structure, data, and behavior. When you look at the current environment, the price action in gold, the strength in the dollar, elevated bond yields, and the emotional state of the market, there is a very strong case that we are sitting right at the edge of Phase 2, transitioning into Phase 3. This is the most misunderstood moment in the entire cycle, because from the outside, it still looks weak. Gold is not making new highs. It's not behaving like a safe haven, and confidence is fading. But internally, something very different is happening. The forced selling that typically defines Phase 1 and early Phase 2 is starting to exhaust itself. Margin-driven liquidations where investors are forced to sell assets to cover losses elsewhere begin to slow down. Volatility starts compressing. And quietly, beneath the surface, accumulation begins. One of the clearest signs of this comes from central banks. According to data from the World Gold Council, central banks have been buying gold at one of the fastest paces in decades. In recent years, annual purchases have exceeded 1,000 tons, significantly above the historical average of around 400 to 500 tons. That's not short-term trading, that's long-term positioning. At the same time, physical demand in regions like China and India has remained resilient, even during price pullbacks, which tells you something important. While price is weak, demand is not. Now look at the broader macro environment. The U.S. national debt has crossed $34 to $39 trillion range in recent estimates, and interest costs alone are rising rapidly. This creates a constraint because maintaining high interest rates for too long becomes increasingly difficult when debt levels are this large. And that brings us to a critical point. The current environment of high yields and a strong dollar, the very forces pushing gold down right now, are not permanent. They are temporary conditions, created by the same shock that will eventually reverse them. This is exactly what has happened in previous cycles. At first, policy tightens, liquidity contracts, gold struggles, but over time, the system begins to adjust, and when it does, the forces that once suppressed gold start working in the opposite direction. Now here's why this moment matters so much. Because Phase 2 feels like failure. It feels like the trade is over. It feels like something is broken. But historically, this is the phase right before the real move begins, and most investors never make it past this point. Not because they're wrong about gold, but because they exit too early. Every cycle has similarities, but every cycle also has something unique. And what makes this moment different is not just the conflict or the oil shock or even the short-term movement in gold. It's the structural environment underneath it. Because when you compare today to past cycles like the 1970s, you're not looking at a bigger version of the same system. You're looking at a completely different scale. Start with debt. In the early 1970s, U.S. national debt was under $500 billion. Today it's above $34 to $39 trillion, depending on how it's measured. That's not a linear increase. That's exponential, and it changes everything, because higher debt means higher interest payments, and higher interest payments limit how long rates can stay elevated. In fact, the U.S. government is now spending over $1 trillion annually just on interest, a number that continues to rise as yields remain high. This creates a pressure point, because the same high interest rates that are currently suppressing gold are also increasing stress inside the system. Now add the second layer, central bank behavior. In previous decades, central banks were often net sellers of gold. Today, they are consistent buyers. According to the World Gold Council, central banks have been accumulating gold at record levels in recent years, with multiple years exceeding 1,000 tons of net purchases. That's not defensive. That's strategic. It reflects a shift away from reliance on traditional reserve assets toward something more stable over the long term. Now let's talk about silver, because this is where things get even more interesting. Unlike gold, silver is not just a monetary metal, it's also an industrial one, and right now, the silver market is in a multi-year supply deficit. According to industry reports from groups like the Silver Institute, global demand for silver has exceeded supply for several consecutive years. That means inventories are being drawn down. And here's the key problem. Silver production is not easily scalable. Most silver is produced as a byproduct of mining other metals like copper or zinc. So even if prices rise, you can't just turn on more silver supply instantly. At the same time, demand is expanding. Silver is used in solar panels, electric vehicles, semiconductor technology, defense systems, and many of these applications have limited substitutes, which means demand is not only growing, it's relatively inelastic. Now combine all of this. Record debt, rising interest costs, central banks accumulating gold, structural supply deficits in silver, expanding industrial demand, and you start to see the bigger picture. This is not just another cycle. This is a cycle sitting on top of stronger structural pressure than anything we've seen before, which means when the current suppression phase ends, the move that follows may not just be a repeat of history, it may be larger. At this point, you understand the pattern, you understand the phases, you understand why gold is falling, but none of that matters unless you know when the shift actually begins. Because here's the truth. The news will not tell you. Headlines will not tell you. Social media will definitely not tell you. By the time the narrative changes, the move is already underway. So instead of watching noise, you need to watch signals. And there are just two, that matter more than anything else. The first is the US dollar index, often referred to as DXY. This measures the strength of the US dollar against a basket of major currencies. Right now, during periods of uncertainty, the dollar tends to strengthen. Why? Because global capital seeks safety in U.S. assets, especially treasury bonds. To buy those assets, investors need dollars, so demand for the dollar increases. And as we discussed earlier, a stronger dollar puts downward pressure on gold. But this doesn't last forever. At some point, as conditions stabilize or as policy expectations shift, the dollar begins to weaken. And when it does, one of the biggest headwinds against gold disappears. Historically, when the dollar index falls below key levels, often around the mid to high 90s range, gold begins to respond. Not immediately in explosive fashion, but with a clear change in direction. The second signal is even more important. The 10-year U.S. Treasury yield. This is the benchmark for global borrowing costs. Right now, yields are elevated, hovering around levels that make bonds attractive relative to gold. Remember, gold pays nothing. Bonds pay yield. So when yields are high, the opportunity cost of holding gold increases. But here's the turning point. When yields begin to fall, especially below key levels like 3.5%, that opportunity cost starts to disappear. And suddenly, gold becomes competitive again, not just for retail investors, but for institutions managing billions in capital. Now here's where it gets interesting. These two signals are connected, because when the Federal Reserve begins to shift policy, whether due to economic slowdown, debt pressure, or financial instability, yields fall. The dollar weakens, and when both of those happen together, the exact forces that were pushing gold down reverse at the same time. That's the moment phase 3 fully begins, and when that transition happens, it doesn't come with a warning. It doesn't wait for confirmation. It simply starts moving. So instead of asking, is gold going up today? The better question is, are the conditions changing? Because once they do, the move is no longer a theory. It's already in motion. Up to this point, we've focused mostly on gold. But if you really understand how these cycles work, then you know the story doesn't end there. Because historically, gold moves first, and then silver follows. But when silver moves, it doesn't just follow, it accelerates. And in many cycles, it actually outperforms gold by a wide margin. Now here's why that happens. Gold is primarily a monetary asset. Its movement is driven by central banks, currency dynamics, inflation expectations, interest rates. Silver, on the other hand, has two identities. It is both a monetary metal and an industrial metal, which means it has two engines driving demand. And when both of those engines turn on at the same time, the move becomes much more powerful. Let's go back to history for a second. During the late 1970s cycle, gold had a massive run. But silver didn't just rise, it exploded from around $5 to nearly $50 per ounce. That's a 10 times move, far exceeding gold's percentage gains during the same period. And the reason is simple. Once the monetary demand returns, once investors begin moving back into precious metals, silver gets hit from both sides. Investment demand increases, while industrial demand never stopped. Now look at today. The industrial side of silver is stronger than it has ever been. Silver is a critical component in solar panels, photovoltaic cells, electric vehicles, semiconductor manufacturing, data centers, defense and communication systems. And in many of these applications, silver is not easily replaceable. That creates a unique situation. Because demand continues regardless of price, at the same time, supply is constrained. As we discussed earlier, the global silver market has been in a multi-year deficit, with demand exceeding supply for several consecutive years, according to the Silver Institute. And here's the key issue. Most silver is produced as a byproduct. So increasing supply is not simple or immediate. You can't just decide to mine more silver because it depends on the production of other metals. Now combine that with another factor. Refining and processing capacity is heavily concentrated in countries like China, which plays a major role in global silver supply chains. That adds a layer of strategic control. So, when the monetary demand returns, when investors rotate back into precious metals, silver doesn't just benefit, it gets squeezed from both sides. And that's when you start to see the kind of moves that catch most people completely off guard. Because by the time silver starts moving aggressively, gold has already been rising for a while. And most investors are still waiting for confirmation. At this point, everything should be starting to connect. You understand the mechanism, you've seen the history, you know the phases, you know the signals. And yet, despite all of this being repeatable, predictable, almost mechanical, most investors still miss the move, not because they lack information, but because they make one critical mistake. They react to price instead of understanding position. Let me explain what that means. During phase 1, when gold spikes on fear, people chase it. They buy because price is going up, because the headlines confirm their belief, because it feels safe. But that's often the worst moment to enter. Then phase 2 begins. Gold starts falling or moving sideways. Confidence drops. Doubt creeps in, and this is where the real damage happens, because now, instead of chasing, people start exiting. Not because the fundamentals changed, but because the price did. They look at their portfolio and think, I was wrong. This isn't working. I should get out before it gets worse. So they sell. Right here, at the exact point where the panic has already played out. The forced selling is nearly exhausted. The structural setup is still intact. In other words, they exit at the bottom of phase 2. And what happens next? Phase 3 begins. Quietly at first, gold stabilizes, then slowly starts rising. But now those same investors are no longer in position, so they wait. They tell themselves, I'll re-enter after confirmation. I'll buy when it's clearer. I don't want to get trapped again. And by the time it becomes clear, price is already much higher. That hesitation is what costs them the entire move, because markets don't reward certainty, they reward positioning. And positioning happens when things still feel uncertain. Now here's the uncomfortable truth. Right now, we are in the exact phase where this mistake happens. This is where doubt is highest, where conviction is lowest, where narratives start breaking. And this is exactly where most people give up, not because they were wrong about gold, but because they couldn't tolerate the phase. So let's bring everything together. Gold is falling during a time when, logically, it should be rising. And at first glance, that feels like a contradiction, but now you understand it's not a contradiction. It's a phase, a temporary phase driven by a mechanical chain. Oil shocks, pushing inflation, expectations higher, the Federal Reserve holding rates elevated, bond yields staying high, the dollar strengthening capital, rotating away from non-yielding assets like gold. All of this creates pressure, but that pressure is not permanent, because the same system that creates it eventually forces it to reverse. High interest rates increase debt stress. A strong dollar tightens global liquidity. Economic pressure builds over time, and when that pressure reaches a limit, policy shifts, yields fall, the dollar weakens, liquidity returns. And when that happens, the exact forces that pushed gold down become the forces that push it up at the same time. That's when phase 3 fully unfolds. And if history is any guide, that phase is not slow and it's not small. It's where gold moves with strength, where silver accelerates, where narratives flip, and where the majority of investors realize too late what was actually happening. Now step back and look at the bigger picture. Record global debt levels. Central banks accumulating gold. Persistent inflation pressures. Structural supply deficits in silver. Expanding industrial demand. This is not a weak setup. This is a compressed one. And compression leads to expansion. That's why this moment matters. Not because of what gold is doing today, but because of what this phase represents. A transition from confusion to clarity, from pressure to release, from doubt to movement. So the real question is not, why is gold down? The real question is, are you interpreting this phase correctly? Because if you are, this doesn't look like failure. It looks like positioning.